Hi guys, welcome to Shiz on the Money, which is all about empowering women to take control of their finances and get money savvy. A few weeks ago, I spoke with Brett Evans, who is the CEO of Atlas Wealth Management, about the 5 things every Aussie living in the UK must know about their finances. We cover all things from HEX debt to pension versus super, how much tax you need to pay while living over here, and also what to do about your university debt. Hope you find it useful. Hi Brett, thank you so much for joining us.
No, my pleasure, Molly. Great to meet you.
Awesome. So we might jump straight into it. So I'm an Aussie and I've been living in London for 4 years. And I haven't really contributed to my super in that 4 years. I've had pensions through other corporate jobs. But question, I guess, like number 1 is, what should I be doing with my super now that I'm an expat?
Yeah, I think it's probably the most common question with expats in any country. And the reason being is, unless you left Australia the day that you graduated, most of us have super in some way, shape or form, whether it's a small amount or a large amount. Usually is dictated by, at what age you went overseas. But it's probably the most common question. And I think, when you're living in Australia, you're surrounded by advertising and all the media saying, treat your super seriously and look after it. But when you get on that plane to go overseas, super becomes a distant, one letter in the mail once a year with your annual statement, and there's a lot more fun things to focus on than look at your sort of balance. So it's to give you a quick rundown. Super's agnostic whether you're a resident or non-resident. So the actual structure doesn't change, which is great for expats because one of the benefits of super is it's a 4 cents of savings. Now, when you do leave Australia and go overseas, believe it or not, you're actually at a financial disadvantage to your Australian colleagues because they've got 9.5% of their salary going into their super every year. Yeah. And if you're not doing some sort of savings that either matches that or at least some sort of savings anyway, then you may fall behind. So when it comes time to return to Australia, it may or may not be as great a balance as you hoped it to be. So we often get the question, do I contribute to my super? And that question's sort of splits off into 3 different areas. The first is, yes, you can, which is great. So, some people like, and we often find it's actually not an age thing. We have clients in their 20s who are contributing to super and we have clients in their 50s who aren't. So it comes down to super's like the mafia, once in, never out. It's there for a long time. You can't touch it until you meet preservation age. And some people like that. Some people, like the fact that they can't, draw it out of an ATM on a Saturday night. So it's sometimes it's a great thing to have, and that you cannot touch it. Yeah. But the important thing is, yes, you can. The biggest thing with super is when you do go overseas, all super is not the same. And it comes down to the actual individual super fund that you're invested in, as opposed to the super scheme in general. So the first thing you need to do is, before you go or even after you've left, contact your super fund to find out whether you're able to be a member of that fund as a non-resident. There's a number of funds that don't allow you, and we've had extreme cases where a client in Los Angeles notified their super fund that they were an expat and they got asked to leave the fund within 30 days. So that's the first port of call. Okay. The second port of call is, can you contribute to that particular fund? Not all funds are geared to accept overseas transfers. Most of the major ones will be able to give you SWIFT codes and those sort of things that enable you to make transfers back to Australia, or alternatively transfer it back to an Australian bank account and then cross into your super fund. But first of all, you need to make sure that they can accept transfers from a non-resident. And lastly, most people, they'll have 3 or 4 funds. So it's often a good time to, make it easier to manage whilst away, to look at consolidating and maximising what you've got, because quite often you'll be paying multiple fees and that eats into your balance. Yeah, a lot of times people don't...
I just consolidated, so great.
Yeah, well done. No, look, it's the easier you make it to manage, the more effective that management's going to be. Yeah. If you have 5 funds, you're not going to give any one of them the time of day, let alone 5 of them. If you've got it down to 1, at least you can control and manage that one and make sure that's working in your favour. So the last thing with super as well too would certainly be around the insurance that's inside of your super. Yeah. quite often you'll have life or TPD insurance inside there from when you're working in Australia. And believe it or not, it's not always the case that you are able to use that insurance whilst you're a non-resident. So you can actually be paying for something you can't actually claim on. And, I'll give you an extreme example of a client in Beijing who moved to Beijing in 1994, became a client of ours 2 years ago. And as a part of a review, we're going through the super, and we contacted their fund and said that, they've been in Beijing since 94. And they said the actual insurance inside of that super fund was invalid because they're a non-resident. So they've been paying insurance premiums since 1994 and had no benefits. So, always pays to go through and call me a bit jaded, but I always say when you're talking to super funds, do it on the email, don't do it on the call center. Okay. And the reason being is you've got a documented proof there, whether it's valid or not. Because we often find that with those call centres, they're geared to the 99% of their members who are Australian residents. As soon as you say, is my insurance valid as a non-resident, they may just assume you're overseas travelling. And they say, yeah, of course it is. That's great. And then you go off believing that you're paying for something, where in actual fact, when you dig a bit deeper and you say, no, I live overseas permanently in London or anywhere in the UK or anywhere overseas, you may be paying for something not actually valid. So that's probably the most common thing we find with clients is, they're paying out good money for something that's not actually valid at all.
Wow, that's a really good tip.
Yeah, and it can be expensive.
Yeah, definitely. Making notes here, I'm like, okay.
Tick, tick, tick.
Great. And sorry, just another question on super. So when it comes to pensions and super, are those things, do they work with Australian English, or once I have a pension in England, will it always be in England?
It's probably the Australian super scheme. Yeah, look, the Australian super scheme and the UK pension scheme are probably the most two similar pension schemes in the world. You can't really compare them to a provident fund in Hong Kong or a 401k in the United States because of the preservation nature. The UK, you can't touch your money till the age 55. In Australia, it's your preservation age, which is for most people now about the age 60 to 65. Up until recently, you were able to move your UK pension back to your Australian super scheme. Mm-hmm. However, the rules changed in 2014 and HMRC wasn't exactly that enamoured with people moving all their money out of the UK. So they found a couple of slight variances between the two systems, which enabled them to sort of drop the boom gate. And now the only way you have ability to move your UK scheme back to Australia is once you reach the age of 55, unfortunately. So, we have a large number of clients who have, we call them orphan pensions sitting in the UK. And, pretty much consider it like a bonus when you retire because, you may not be able to touch it for a long, long time.
Okay. Good to know. And as far as super goes, that's a great summary, and that gives us a really good kind of checklist of things we should be doing with our super. Is there anything else on super that we should really be aware of before we move on?
Yeah, look, probably the biggest one, which may or may not affect your viewers, is those who may have a self-managed super fund, which the popularity of having a self-managed super fund in Australia is on the rise. And unfortunately, the rules for a self-managed super fund are quite different to a standard retail or industry super fund. And the reason being is there's two main rules that we have. One's called the active member test and the other one's called the central management and control. And you've done the right thing. You've consolidated your super. You do have a certain amount of control. If you're a non-resident living in London and you have a self-managed super fund, the problem you may have is you can't actually control that fund. So what you'll need to do is either wind up the fund and then roll it back into a retail platform, or you may need to appoint a family member or someone with a power of attorney and change them to be the trustee of that fund. So there's quite a lot of effort in unpackaging it and restructuring it. So I won't bore everyone too much with the technical details, but just to say that if you do have a self-managed super fund, everything I said before is slightly different, and you do need to seek advice on that because we are quite busy in making changes to clients' expat SMSFs because of the different rules that exist.
Wow, no, this is great because people they don't know about these things. This is really interesting.
Yeah, because we often find that the biggest thing is when you do decide to go overseas, whether it's because you're being moved by a company or you decide to work overseas, you Google where you live, you know, where the kids are going to go to school, you know, all the cool stuff. You don't Google how's my super change if I move overseas. So quite often we find that people become clients of ours at the 12 to 18 month mark when they found out, wait a minute, I've got an issue here, I've got an issue here. So
yeah, so true. In my Google search of best restaurants in London, I wasn't like, oh, what about my super? Yeah.
exactly. Yeah, and we get that. It's not the most exciting of things.
No, awesome. Okay, so just changing to a different subject. So I went to uni in Brisbane, and I have a university debt. When I was in Australia and working a job, it was coming out of my pay. But now I'm in the UK.
Yep.
I'm not really doing anything about it. So I guess, so does university debt still work when I'm an expat? Is there
This has probably been the most common topic if you look at all the Facebook groups and LinkedIn groups and a lot of those different communication methods. And we've been on there trying to, you know, inform people of the changes and certainly in the lead up to the changes. So just to give you the sort of the cookie cutter explanation of the changes that came through, as of the 1st of January last year, all new expats had 7 days to notify the ATO of their new contact details overseas. And then as of the 1st of July, I can see nodding your head going, maybe I didn't do that. And then on the 1st of July last year, now anyone who has a HEX, HELP or TSL debt in Australia has to lodge what you can consider a worldwide income declaration to the ATO.
Okay.
And the way that works is if you have a salary of less than 14,000 Australian dollar equivalent, then you do not need, all you need to do is tell them that you have a salary below that amount and nothing's required.
Okay.
If your salary is between 14,000 and 54,000, then you still need to tell them that amount, and they will tell you that you don't have to declare, you know, don't have to make a payment because you haven't met the payment threshold.
Okay.
And then if you have a salary of greater than 54,000, then they will take that salary and apply the HEX debt threshold repayment schedule, which starts at 4% on your worldwide income. And then they will provide you with what's called a notice of assessment, and then you will need to make a payment based on that. So it's pretty simple to work out. Where it gets a little bit confusing is a lot of the tax years are quite different between the Australia and the UK and any other countries as well too. And it's trying to line up what your salary was in those different points of time. And what I'll do is I'll provide a link to an article we wrote on the different ways that you can actually lodge and notify those different salary amounts. You can do what's called a simple method where you virtually say, my name's Molly, this is my income, and this is my category of work, and they'll provide you with a nominal level of deductions that are normally applicable to people in Australia. Or there's a comprehensive method at the other scheme where you can go through and do quite a bit of work. But at the end of the day, everyone has to do some sort of notification. For those who missed the 31st of October deadline, if you do engage an accountant, you can get that pushed out till March this year. So, and we work with a number of accountants, and they're not actually charging that much for this service. And for a lot of people, it's just a peace of mind of just going, make it go away. And then once you get going and get used to the new reporting regime, you've got a bit more time to get used to it and everything. So we often say to clients, if you can pay that HEX debt out, then that's fantastic because you no longer need to report. Yeah. But at the end of the day, there is some sort of requirement for everyone who has the HEX, HELP or TSL debt.
Okay. Another quick question is, and we see this one a lot as well in different groups, and it's just about like transferring money. So if I've got savings and I want to transfer it to pounds, or if I've got pounds and I want to transfer it to Aussie dollars, what's the best way to do this? Is there a best way? Because we know there's tools out there like TransferWise and other ones similar, but like, what do you guys reckon is the best thing to do?
Look, we definitely recommend using the currency brokers. The two that we work with personally are OFX, which used to be called OzForex, and also World First. Yeah. Each of the different providers has their sort of different price points. TransferWise is very good at doing the small balances in terms of providing the best rate. At the end of the day, just don't use the banks. Use someone else but the banks. Yeah. yeah, we've seen people use strategies like PayPal and other things as well too, which can work on the lower balances. But if you're transferring, let's say, for example, a couple thousand Australian dollars, then it is worth your while to look at a currency broker as opposed to using the bank. People use the bank because it's easy. You've got your net bank or your internet banking already set up. You just plug your details in and then you get on with your day. Sometimes it's a little bit of extra effort to set up a account with a TransferWise, an OFX, or a World First. But once it's set up, it's no different to opening up a bank account, 100-point ID check, and those sort of things.
Yeah.
But once it's set up, then it's so simple to actually do it. Virtually what happens is if you're sending money, say from the UK back to Australia, then you essentially just transfer the money into their UK bank account, and then it spits out in Australia out of their bank account into your nominated account here. So usually looking at about at the most 2-day time lag. So it's still very quick. But you're saving anywhere between, call it 20 quid on smaller balances up to thousands.
Wow. Okay, great. I'm an Aussie living in the UK. Do I have to pay tax while I'm living abroad?
That's probably the other most common question, apart from the super one. And the reason being is it's such a grey space. And there's a good reason why the ATO is not exactly the most forthcoming of people in terms of telling you, do you have to or do you don't. Mm-hmm. And when it comes to do you have to do it, there's 3 main tests that you have to comply with. Yeah. The first is the resides test. Where do you live? Do you live overseas or do you live in Australia? The second one is the domicile test. And the domicile test comes down to, have you set up permanent domicility in another location? Do you have a lease in your name? Do you have utility bills? Mm-hmm. Is the move permanent, or can it be seen that you're coming back to Australia and you're going overseas just to try and avoid tax? And the last one is actually the behaviours test. Now, you can meet the first 2, mm-hmm. but the last one is the one that catches a lot of people out, because it's, do your behaviours match that of a London resident or a Sydney resident? And we often find people where they may have families split across 2 jurisdictions. Mm-hmm. That's where, so even though they might be living in London, the wife and kids might be in Australia. Yeah. So they can argue that your ties are to Australia, even though you're living in London. So for those majority of people, it's a very simple test. If you virtually have cut ties with Australia, moved overseas, you've been overseas for a certain period of time, you're paying tax overseas, then normally Australia has what's called double taxation agreements with countries. Mm-hmm. So they'll recognise that, okay, you've paid tax to HMRC in the UK, and that's all said and done. It's if you've sourced Australian sourced income, that's where things can change. Australian sourced income may be, you might own an investment property and you're sourcing rental income. Mm. So in that case, the tenant pays you the money, and then you have to declare that money to the ATO. Okay. So that's what we call Australian sourced income. Where it's a little different for those who have investments like shares or managed funds or ETFs. Yeah. In that case, that's what's called taxed at source. So before they get paid the dividend, the share registry will look at your place of domicile and say, okay, Molly's in UK, there's a double taxation agreement in the UK, therefore we'll take out 15% automatically and pay the 85%.
Okay.
So it depends on how the money's sourced, in terms of, it dictates how you have to declare that, or do you don't have to declare that. So if it's all done for you, the best example is those who have a bank account back in Australia. Mm-hmm. You might get a bit of credit interest on that money. The bank will automatically take out 10% of the credit interest, and that's what's called tax at source. Okay. So you don't need to declare that on a return. You just need, they'll do that for you. Where it comes to, there's good housekeeping practices that we talk to clients about in terms of when they're about to go overseas. Mm-hmm. The best one is obviously engaging an account to do a notification to the ATO of your intention to move overseas. Yeah. And virtually what that tells them is, I'm going overseas, I'm not going to be earning income in Australia anymore. They don't expect any other returns from you. Mm-hmm. It's good practice to do, updated returns, notifications to the ATO. But if you do that main one, then the ATO knows that you're overseas. Whereas if you just suddenly disappear, the ATO doesn't know that Molly's in London. Yeah. And it suddenly wonders after a couple of years, where's your tax returns? Because you haven't notified them you're in London. Okay. So it's those little housekeeping issues which just take away the confusion, and means that when you come back as well, that there's no bad letters waiting for you.
No scary letters in the mailbox.
Exactly. Yeah.
Awesome. Okay, great. And then I guess so when I first moved to London, I dreamed of like maybe owning a house one day in Pimlico. It'd be wide and beautiful. But I think my reality would probably be more like Zone 7 yeah, out the back of like nowhere. But so just with property, so if I was going to buy property in the UK, are there any property rules as an expat I need to be aware of?
There's rules both for UK and Australia.
Yeah.
So in the UK, if you were to move back to Australia and kept that property in the UK, then you would be declaring that property to the ATO, as well as doing a local tax return in the UK for any rental income. So because of that double taxation, I said before, HMRC gets the first bite of the cherry on any tax, and then the ATO will tax you on top of that if there's enough income to be sourced from that point of view. The biggest one that we're finding the confusion is actually those who have property in Australia. And a lot of people, because buying Australian property when you're living here is such a big thing, a lot of people are doing it at a younger age, and then they jump on a plane, and what they'll do is they'll actually rent the property out. Now, up until recently, or up until May last year, there was a rule called the main residence exemption that could be applied to non-residents. So let's say, for example, you bought a property in 2010 and you lived in that property until 2015, and then you jumped on a plane, moved overseas and rented that property out. Then under the main residence exemption for non-residents, you had 6 years after you jumped on that plane in that you could sell that property capital gains tax free, even though you had a tenant in it paying it off for you. So the Australian federal government's now dropping the boom gate on that one as well. And for those people who are, already overseas as of the 8th of May last year, they have until 30 June 2019 in either to sell that property or go onto the new regime, which means you pay capital gains tax. For those people who became an expat after the 8th of May last year, if you were to go overseas, and these rules are proposed, they haven't passed government just yet, but they are proposed. If you, let's say, for example, you bought a apartment in Glebe and you had a very nice run up, you lived in that property for a couple of years and then jumped overseas October last year. Under the new rules proposed, there's the potential that if you were to sell that property overseas, you would have to pay capital gains tax for that whole period of time. Not for the period of time that you were a non-resident, but the whole period of time back to when you actually bought that property originally. So for those in Australia who have ridden the property rise, there's the potential of some quite large tax bills that may come out of that as well if you were to sell that overseas. Okay,
interesting. Definitely one to be well aware of.
So it's like sort of when you're buying property, it's like sort of tapping your head, rubbing something at the same time. It's you got to think in a two-dimensional space.
Yeah, gosh. All right. Well, thank you so much, Brett. That's been so valuable and so interesting to like hit all those topics. I know there's a lot of things that we're going to take away to Shiz on the Money and really explore further. So guys, that was Brett Evans. He was the managing director at Atlas Wealth Management, and you can check out their website at www.atlaswealth.com.au. Thank you so much, Brett, for your time, and we'll speak to you soon.
My pleasure, Molly. Thank you.
Right.